Forex trading for beginners. Let's get straight into it. So now we're going to be delving into market structure a bit more now. And when we're talking about market structure, we need to think about something. Let's just say we're looking at GBP/USD and this is a downtrend. As you can see price is making lower lows and lower highs. One thing to bear in mind is that price is always going to be moving from a premium to a discount, premium to a discount, premium to a discount. And what I mean by this is this. I'm going to bring out this tool. This tool is known as a Fibonacci tool. And people use it for entries. People use it for all these different things. I don't use it for entries. You go to Fibonacci retracement tool and then basically it'll pop up like that. What you're going to do is, you don't have to do this. If you've been trading Forex for quite a long time, you'll be able to understand and see for yourself that price is at a premium and price is at a discount. So let's run it back. Let's do it now. When price got to this level over here and expanded all the way down to this level, you can see I've dragged it from the swing point, swing high to a swing low. And you can see now, if I just quickly change this up, this Fibonacci tool, just to show you guys my numbers. As you can see, I've got the 61.8 Fib on, I've got the 78.6 and I've got the 88. I'm gonna throw in the 50 as well actually. I need the 50 on here just to show you guys what I mean by this. And I got the 50. So basically what this Fibonacci tool tells you is that it tells you when price is retraced back to equilibrium, which is basically 50% of this expansion down, or into a premium. Basically what this 50 number represents, so let me just zoom in. So what this 50 number represents is that this whole expansion down, when price is retracing, it's retraced back 50% of this whole expansion down. So let's just say price expanded down 600 pips. It just basically means price will retrace back 300 pips when it gets to this point. Price is at an equilibrium. So in other words, it's retraced back 50%. And generally at 50%, price is allowed to trade lower. What we like to do is we like to trade price when it gets into a premium price. We don't use these numbers, by the way. We don't use these numbers for entries. We don't use these areas for entries. I'm just showing you guys using this tool that price is retraced back into a premium price. And generally, so what we like to do is we like to wait for price to fall into a premium, normally mitigate something, and then continue to drop lower. That's what we like to do. And so when it drops into these areas over here, just remember, don't focus on the numbers, just focus on how far it's retraced. When price is retraced back into these levels, price goes into a premium price, and that's where you want to be selling price from. You don't want to be selling beneath 50% because price is not even at equilibrium yet. You want to be selling price when price is in a premium price. And then constantly, you're going to be seeing this price is going to be dropping from a premium to a discount constantly. Look, premium to discount. Again, I dragged my tool from the swing high to the swing low. Price broke structure down here. Don't look at this as the break. This is nothing. This was just a low generated for more liquidity. You see how this low, when it came lower, it never beat the low? That means we're still trading within the trading range. But look, when price broke structure to the downside, this is when it did it. When it broke this low, it retraced back up into a premium price and then it dropped again. One more time, we're going to go into this again. Go into this one more time. From this very high to this very low, what has price done? Price has expanded lower and it's retraced back nearly about 88% of this whole move down. So in other words, this was heavily premiumed. And generally the 61.8 Fibonacci is normally the retail golden zone, the retail level that they just love selling price at. The best place to sell is when price gets up into a premium price. After price goes ahead and mitigates whether it's going to be an up close candle, whether it's going to be some kind of imbalance, right? Price will go and mitigate these levels and then drop. So let's talk about trading ranges now. You can see this high, and then this is our low over here. Basically, what this just shows you is that this is our trading range. Let's just say this was just a whole massive downtrend continue. This was just another low, low, and a lower high. But as long as price is staying within this range, we are still in a downtrend. Price is still trending lower. No matter what you see, price is still trending lower. When price got to this level and then retraced, some people might have been seeing some kind of high low, even though it wasn't a high low because we're still trading within the same trading range. The moment price broke out of this trading range, as you can see, there was the breakout here. This is where price broke out. This became our new trading range. This high and then this low. So now this becomes our new trading range. Not this high over here, is this high and this low. Remember this, because people like to get confused, you know, like, is it an uptrend, is it a downtrend? Look, this is our range. As long as price is still respecting these highs, we're still pushing lower. And this is our trading range. So no matter what happens, when you see price pushing up, people are going to start thinking uptrend. No, we're still pushing lower because price has not broken this high yet. If or when price breaks this high, that's when there's going to be a break in market structure. And then generally you want to see price return back down, protect the low and push higher. But as you can see, it didn't do that. What did it do? It then went to violate the low again. So guess what? Our trading range becomes this high and this low over here. So now we have a new trading range. So no matter all these little bits in between, it doesn't matter. Keep your eyes on the bigger picture. Keep your eyes on a higher time frame. Don't get caught up in the lower time frames trying to look for market structure. You won't find it, okay? You'll be pulling out your hair. You'll be super confused. There'll be days you just be getting tossed left, right, and center in the market. You don't want to do that. What you want to do is you want to focus on the higher time frames, the dailies, the weeklies, right? The higher time frames, and getting your buys from those time frames, and then waiting for the smaller time frames to line up with what the higher time frames are saying. The lower time frames, I only go there for entries and that's it and nothing else. And guess what? We are still trading within our trading range. Nothing has changed. So until this range, this high is violated or traded through or whatever you want to call it, we will not be thinking bullish until it's violated. If they go forth and break these lows, you can see there's like all these lows close together, lots of consolidation here, lots of liquidity down here. We're still in a bearish market with GPUSD. It's been dropping. There's nothing's changing. It's still dropping until it shows otherwise. We're not in a game of guessing. We want to trade what we see, not how we feel. Now I'm going to quickly show you the range on an uptrend. You can just literally see it here. It's going to be exactly the same stuff. You can see this is our low. This is our low. As you can see, all of this is our low. I haven't really done it properly. That's our low. And then this is our high right here. You can see when price expands high, it retraces back down. It doesn't beat the low. It goes forth and breaks the high. It shows that we are pushing higher. Now, the moment it breaks this high, what happens? We then move this and move it here. And then don't forget, these ranges not only we're not using these ranges as support zones and resistance zones. We don't do this on this channel. We don't trust support and resistance. None of that. We don't go by that. I'm literally just moving these rectangle boxes just to show you and identify the new range. As you can see, look, you move this level to this low over here. This becomes our new range. And then this becomes our range high, our range low and our range high. Range low and range high. In what kind of era you want to be buying gold in? You're going to be waiting for price to get into a discounted price. So when we were selling, we were waiting for price to get into a premium price, but now we're buying, we want price to fall into a discount. And so now when I bring out that same Fibonacci tool, dragging from the top to the bottom, or so from the bottom to the top, don't forget, we're not using these numbers as entries. We're not using these levels or whatever you want to call them as entry points. We're using them just to show you that price has dropped into a discounted price, and you want to be a buyer when price is at a discount, not where price is above discount. And then look, let's drop it again from this level to this high. Look at this. When price expanded higher, price is now falling into a discounted price. It could even drop even lower. And now we want to see price going higher to seek the buy stops above here now. And another thing we need to talk about regarding market structure, this is vitally important as well. And it's something that I never learned this in the very beginning when I first started trading. But you guys who are starting to learn how to trade now, this is probably like a gold mine for you, because this is what I would have wanted to be taught to myself back then when I first started trading. So guys, check this one out. This one's going to blow your mind as well. Bear this in mind at all times. You don't want to ever be a seller beneath a low, and you don't want to ever be a buyer above a high. You don't want to be sellers beneath lows, because who does that? Normally retail concept traders, they're breakout sellers. And remember what I said in the very beginning, you want to be selling from a premium, and then once it gets to these levels, you want to be offloading your sell to willing participants, willing parties who want to sell the market. They want to sell. If price gets beneath this level, I'm selling the thing. So you want to be offloading your sell. Not necessarily closing out your whole position. If you did want to do that, then by all means go ahead and do that. You don't want to be an aggressive seller down here. This is something I always tell my mentees. You don't want to be super aggressive selling beneath a low, because you have to think about it. There needs to be willing participants you need to offload your position with, your sell with. Because like I said, for every single seller, there must be a buyer. And so if you're selling price and you get down to this level, and these breakout sellers want to sell price, or these people looking to protect their money, they need the other side. They need someone to be buying. When you're selling GPUSD down, when you close off your trade, you technically buy your position back. That's what you're doing. And so when you're buying your position back, you are being the counterparty to the people who are selling's order. So if they're selling, they counterparty with your buying. It doesn't mean that you're going to jump into a new buy. It just means you're closing your position. And so you don't ever be a seller, well, a super aggressive seller, okay? Because there are opportunities to scalp and to sell down here, but you don't want to be aggressively selling down here. What would normally happen is price would then rally up, stop you out, come into some kind of form of mitigation play, and then it will rally down again. You don't want to be a super aggressive seller beneath these lows, even though it's going to give you a decent amount of pips. But guess what? Look at this. There will be scalping opportunities. There will be like a number of opportunities to get in for sales, but you don't want to be super aggressively selling. You might want to reduce your risk. You might want to step away and, be done trading until when price starts to retrace. Remember who sells down here. You want to be selling from beforehand and offloading once you get to these levels. And it's the same thing with these buys. You don't want to be super aggressively buying above these highs, only because there's going to be willing participants to buy up here. You want to be buying from a discounted price and offloading your position when price actually runs out that liquidity. When price is spending time up here, it's literally matching, pairing off orders with those people who are willing to buy, gives them a piece of the pie and runs against them, stopping them out. So you don't want to be buyers above this level either, because this is most likely what is going to happen, especially if you're trying to swing trade up here. Come on, I don't know what's going on. If you're trying to swing trade above an old high or above a high, you're playing yourself. You're playing yourself. You need to be swing trading from the discount into this level. That's what you want to be doing. Then either collapsing the whole trade or taking part of it off and letting some of it ride to do this filthy work. I call this the leg work. Let your runners do the leg work. My mentees know that. Just type leg work down below in the comments if you know about the leg work action. So now we're going to be breaking down something else to do with market structure again. So like I said, this is going to be a full training, guys. You're going to be getting so much knowledge on this training. We're going to give it to you all at once right here, right now. I have other series going into more depth into most of these different things that I have talked about so far. There's going to be cards linked up on above, and there's going to be links in the description for all those playlists as well. Another thing that could aid you in identifying in which direction the market is going is looking at the institutional candles. And just to break down what an institutional candle is, I'm going to bring up my trusty whiteboard just to explain that to you right now. So normally price will be doing this, we're going sideways, and then it might just expand higher like that and then drop lower to retrace again and then to go again, to go lower. And so basically what's happened here, this is known as an institutional candle. So this candlestick here, all of this from this low to this high will be the institutions running out the liquidity that was resting above here. Normally what would happen is, especially when price is looking to go lower, you will see it expand higher. Right, it might take out some lows first, but generally you see the institutional candle because it would expand high like this and it break lower. This becomes the institutional candle from this low to this high. And so this is them buying before they sell. This price would then go into another consolidation, or it might not even go into consolidation. It might just be one high, and then price would just expand up into this level to mitigate this institutional candle that was in drawdown, and then to take price low again. So in other words, you get the institutional candle again, as you can see, right? And then price expands lower. I know it looks really messy, but basically this is what you want to see when price is looking to go lower. When price is looking to go higher, you would normally see price produce a low, it will run out that liquidity, then it will break high like that. This becomes your institutional candle where they sold price down before they bought, and then price would expand, come back to mitigate at this level, right? All of this, and then come back to mitigate, and then it will expand higher again. So now when it comes to this chart, this is just gold on a 4-hour time frame. I thought I'll show it to you on this time frame because it looks really clean, really nice, and very straightforward. Price is consolidating. Price consolidated down here. This is consolidation right here. This is consolidation. Price is moving sideways, nothing's happening. Imagine every single one of these candlesticks when a 4-hour time frame took 4 hours to form. How many days was this? From this level to this level, that was roughly about 4 days of consolidation. That means you would have been in that trade, scratching your head, selling at this level, buying at this level, being stopped out, then being stopped out with this huge institutional candle. This is where they started buying from. This is where they stopped buying, as you can see. This whole move here from top to bottom became the institutional candle that ran out the money resting above here. All of this consolidation. And then price expanded away, fall back into consolidation again, and then another institutional candle came up into this level to mitigate this one. This is where they started buying from. So when price came back up here, this is technically where they want to be coming out of these drawdown positions. Then what would happen after that? They are buying before they sell. They'll fall into some kind of consolidation, or they'll produce a high and then they run that high. Run that high specifically into another institutional candle or an up close candle to mitigate that position. come out of their drawdown positions to then continue price going lower. You can see the banks are in a move because they're leaving imbalances, they're leaving inefficiencies because there's uneven trading going on. But if let's zoom in real quick, you can see how this high never came into contact with this candle's high or the wick. It never engaged with it at all. That means there was inefficiencies in the market and price had to trade up into this inefficiency, into this area over here to balance out the area, and then for it to continue going into the direction it wants to go into. This is known as an imbalance. Just in addition to that, it just basically means that only sell side was offered to the market, and so they had to bring price back up to offer buy side to the market before continuing lower. Some people use imbalances as entries, or some people use them as just, reference points as well. Huge inefficiencies left behind. They come out to clean up the inefficiencies and at the same time mitigating the up close candle, and then they drop again. Every single time price retraces, it takes out lows. Look at these lows being taken out here. You see more lows taken out here. See another set of lows taken out here. So in other words, what's happening? Price is violating the lows and protecting the top side, protecting these highs. They mitigate at this level and then they shoot price lower, taking out the low. They come back up for mitigation and then they drop price lower again. So now when it gets down to this very last point, I do have a whole series on this. So guys, it will be linked up in the cards. Another way you can determine the market structure is following the institutional candles, following what they are mitigating. If they are mitigating up close candles, you stay bearish. If they are mitigating down close candles, you get bullish. And then it gets to this point right here where price, look at this, they come up for mitigation of this level. They push lower. They don't really go anywhere. Giveaway. And normally they're generally trading into something here. I believe it was another down close candle. I can't remember what it was now. But they're generally trading into something down here. So now, look at what they're doing here. This is here a bit early, but it's all good. So I'm going to remove that. These pushes down are becoming a lot smaller. So generally, price is kind of giving you the idea that price is getting ready to turn around. The agenda's finished. From this level here, what do? They push up higher, violating this high, which is an up close candle on a lower time frame, or an institutional candle on a lower time frame, and they also violate another one. So in other words, they're giving you signs that price is turning around. The moment they violate these highs, that means now this becomes your down close candle. Whenever price drops into this down close candle, this is technically where you want to be getting bullish, and this is what it did. And as you can see, if I just hit play, I do have other things on the chart. You can see after lots of that, you can see it starts to attack all these highs. This is how you can determine market structure using institutional candles. Vitally important. It was a great addition to market structure in general. I'm going to be talking to you guys about reversals. How do you know when price is reversing? I get that question asked all the time, and I'm about to show you guys 2 examples in a diagram format first of reversals. So let's break it down. A reversal is basically when price is changing direction. And what you want to see is this. You want to see price making higher highs, higher lows like this. And then the moment you get a break beneath this low, this is a break in market structure. What you're looking at is price coming up to this level, mitigating whatever it wants to mitigate at this level, and then continuing to go lower. This is a market reversal. What's happened is price is broken lower beneath the low. So when these lows were being protected over here, the moment it broke beneath this low, the lows are no longer being protected. You want to see price now start protecting these highs. And so when it retraces back up, they don't trade through these highs, they mitigate this level, they drop lower like that. In other words, these highs are being protected. And so this is basically a market reversal when price changes direction. Let's just say this in the daily time frame. On the 1 minute time frame, you might see that price was expanding in this level, gave you a reversal sign, and then dropped. You can get this on any single time frame, whether you're looking at the 1 minute, whether you're looking at the daily time frame. So this is like a normal reversal. We're going to look at it on the opposite side now. So let's just say price is making lower lows and lower highs, as you can see, like that. Highs are being protected. The moment you get a push above this high, let's say they even take 2 of those. It doesn't really matter. If they take 1, that's good enough. Price will then retrace back down, do some form of mitigation, and then break higher again. This is a normal reversal. This is just what you would normally see. It can be on any single time frame. I've already broken down what's happening above these levels regarding liquidity, institutional candles that they come back down to mitigate, and then they come back to run this liquidity that was resting above here. This is a normal reversal sign. So normally there's going to be some kind of liquidity being taken from these levels. They take that liquidity and then they expand higher. And then another form of a reversal sign is normally one where they generate liquidity first and then they run that liquidity and then they reverse the other way. So in other words, what you just saw was just normal lower lows and lower highs. So they could do something like this where they generate liquidity, they create some kind of equal lows close, normally the retail sign to buy. Retail are going to put their stop losses down here. And what you would then generally see is you see a run of these stop losses, and then you see price expand higher. Like this. Normally we get this at some kind of strong kind of support zone for retail, or a zone where they think price is going to go higher. They will get this little bounce, they'll get the indication that price is going to go higher. They might trade higher for a day, give them the opinion that price is rising, and then stop them out. Activate those sell stops and then drag them sell stops back into the range, stopping these guys out, the breakout sellers, and then coming back down for mitigation. We go again and we go higher. And then when it comes to this level down here, by the way, it doesn't have to be equal lows, it could just be consolidation. And then price is just consolidating. But all you're kind of looking at is that they've generated liquidity before they've reversed. They generated more liquidity by dropping into a consolidation zone, accumulating more orders on both sides, and then they ran it to the bottom side and then expanded higher. So that's another form of reversals. Now I'm going to show you this on the charts. This is a normal reversal sign. So they've created a low over here. They've come up a bit higher. They've run that liquidity. They've run this low, and this was liquidity down here too, because there's going to be liquidity beneath all these lows too. They've run this liquidity and then they've expanded higher. They came back down to this level here for mitigation, and then they continue to expand higher. This is a normal reversal sign. So in other words, this is what they've done. So from this level, they've dropped from this level to this level here, and they've gone from this level to here, down to here, 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 boom. Big push, running out these highs and running out these highs here. So this is just another example of GPUSD, and I just wanted to show you an example of them generating liquidity and reversing this time. So here you can blatantly see what they've done here. They've created equal highs over here. You guys know what's above equal highs. You guys know I preach it all the time in this channel. This is a generation of liquidity. So we've got equal highs over here. When retail get equal highs, something like this, normally a sell signal. Let's sell, sell, sell. This is the signal. They might get a rejection, maybe a 4-hour rejection. They might see it as a 4-hour rejection as a strong rejection, and so you should sell. And look, price does drop in their favor. It does drop in their favor. It drops about 80 pips. That is a wonderful amount of pips. Don't be that person who's always trying to catch 300, 400 pips. Listen, when you're first starting out trading, you need to be banking them small wins, them 30 pip wins, them 50 pip wins, and you have to be obviously focusing on your return, okay? Return, your percentage return, not necessarily the pips. When I first started trading, I was focusing on pips. I started learning more, then I started focusing on return. And we're going to be breaking that down for you in a second. And so check this out. They would have got a piece of the pie. 8 pips is lovely. Okay, 8 pips is lovely. Ultimately, look what happened. Price came to run them out. Let me just zoom in a bit more on this level. Putting their stop losses in this area over here. And then this is what happened. As you guys know, there's tons of sell stops up here. People willing to be buyers above this level. They trade up into this zone, stopping out those people who are looking to sell from these double tops or these equal highs. Okay, they stop them out. And look what happens. Then they drag price back down into the range. But when they traded up here, they activated those buy stops. Then they pulled those buy stops back into the range, stopping these guys out. And then you can see that they will continue to expand lower. This is all part of their drop. They've retraced back up, and then they're dropping again. You can see they're dropping again. They generated liquidity first, then ran it with an institutional candle, and then dropped price lower. And so this is why they came up to this level to mitigate at this level. You see how they spent some time mitigating? Price spent forever up here. 19th of October all the way to the 26th of October. That's a very long time. That's a whole 7 days of trading.